Welcome back to Echo Trade. It's Jeff Roth with Echo Trade, and I'm here with Justin Carbonneau from Validea Capital Management, and we're talking about their portfolio, which is available in Echo Trade, wide moats and big brands. Justin, appreciate you being here.
Hey, Jeff. Thanks for having me.
So quick background on Justin. So Justin has got an MBA from University of Connecticut. He is the co-host with his partner at Validea, Jack Forehand, on the Excess Returns podcast. And the team is rounded out of Validea with John Reese, who's smarter than everybody in my office, probably with the MIT undergrad and MBA from Harvard. So he's checking those boxes off pretty well in the Ivy League. But we appreciate the partnership and the expertise of these guys partnering with us and offering their portfolios in Echo Trade. But Justin, let's dive into the wide moats and big brands portfolio. So can you kind of give me, what the overarching thesis of the portfolio is, what your objective is within the wide moats and big brands?
Yeah, so this specific investment strategy is really focused on identifying companies that have wide moats around their various business models. Now, if you think of what can drive,
and a wide moats being you have some protection from competition at the very least, correct?
That's right. You have a competitive advantage over your competitors or others in your industry, and that competitive advantage leads to higher than average levels of profitability. And the moat can be a result of a strong brand name. It can be a result of a monopolistic type of position in the industry. A moat could be some type of intellectual capital moat that you have. There could be intangible moats. Something like, if you think of some of these big technology companies, Apple clearly has a very recognizable brand name. It's able to charge a very steep price for its products, at least here in the US.
Yeah.
By the way, Apple is Warren Buffett's largest position by a long shot. So clearly, this wide moat concept actually comes from Warren Buffett, and Buffett disciples who talk about trying to find these companies that have protection around their business, around their profitability. Because if you think about it, the idea of a moat is when a company is highly profitable, you always have competition trying to attack your profitability. Yeah. So the wider the moat, the harder it is for them to possibly attack you. Now, corporate, capitalism and U.S. history shows that maintaining that moat over a very long period of time is very, very difficult. When you go back and look at, through the 40s and 50s and 60s, the companies that were at the top of the S&P 500, none of them are there anymore. Even if you go back to 2000, General Electric, or, they're not even in the top 20 of the S&P. So there is this constant battle going on in corporate America and publicly traded companies. But, what we're trying to do is say, okay, what companies can we identify that have wide moats, and then buy the best ones? And you can get at this moat idea through fundamental analysis, which maybe we can talk about, and then buying the best ones for the portfolio that we're running on Echo Trade. Very focused 10 stock portfolio, but it's very recognizable names that are household names. I think investors would recognize pretty much all of them, and they're all high on the quality spectrum.
Yeah, but like you said, so 50 years ago, even 20 years ago, the names at the top of that list are not the same. But with those two factors, big brand name, wide moats, competitive advantages, that in and of itself, that company is not going to take a 50%, a 60%, a 70% hit. They're not going to go away in the course of a year or two. So they have some protection in and of itself within the very companies that you guys are investing in, to kind of it is a concentrated portfolio, 10 stocks, but you have some protection from the types of companies that you're investing in terms of the risk management strategy that you guys are employing.
Well, and that's a good point, because one of the things that we look at is the long-term profitability. So profitability over the last decade, and then return on equity and return on capital over the last decade. And companies that have consistent profitability and higher than average return on equity and return on capital over the last 10 years, it indicates that there's some type of protective moat around their profitability and their business model. But to your point, if that starts to deteriorate, If all of a sudden, let's just say we have these 10 companies right now. Let's 12 months in the future. If 3 of those companies actually saw an earnings decline and saw a decline in return on equity, well, that would signal that maybe the moat is starting to deteriorate. So in our system, that would be starting to move towards a sell. But I think you made a very excellent point that it's not going to be some catastrophic fall off a cliff. This company's earnings are cut in half. It's like a slow burn. So what you want to do is you want to try to make it so, okay, you have a system that is constantly looking at these fundamentals. And when that deterioration starts to happen, you have a disciplined, systematic way to move out of those securities and then move into other stocks that are scoring high. And that's exactly what our process is set up to do.
Exactly. And with the types of companies that you're investing in, it's actually, it should be, theoretically a little bit easier to identify those shifts because they're such large companies. They move so slowly. And so you can identify those things easier than a small cap company, that one deal could be a hockey stick growth for them, or, one bad press event or whatever it might be could again, kind of cut their revenue in half. So it's you have the protection there, and hopefully it's easier to identify those, the negative and then the positive factors that could go into, making a decision on what to put in the portfolio or what to take out. So talk a little bit about that, with how you guys are looking at this. You're looking at it from more of a fundamental basis, not really on a technical kind of price chart basis. It's more fundamentals. So what's that investment process look like on deciding, what to put in and then potentially when to take something out of the portfolio?
Yeah. So what we do here at Validea is we run a series of investment models. We run a model based on the book Buffettology, which is inspired by Warren Buffett's what I would consider high quality, large cap type model. But then we run a whole bunch of other models based on legendary investors and other academic research. This particular strategy is really focused on the strategies that are more on the high quality type of names. Because if, within our model lineup, so we run 45 distinct stock selection strategies.
Yeah.
By their nature, some of them tend to be more small cap. Some of them tend to be a little bit more growthy. Some of them tend to be a little bit more quality. So, Buffett would be included as one example of one strategy that would go into this like composite score that overweights the quality models that we have, because those are the types of models that sort of vet out these companies with competitive advantages around their businesses based on the underlying fundamentals. And then, it's a matter of combining those strategies together, running those strategies with discipline, following those strategies for the long run, making sure we maintain a disciplined rebalancing frequency. So that means, a few times a year, we're going in, we're looking at what stocks have fallen in score. We're looking at, by the way, another important aspect is what stocks we have gains, sort of the tax efficiency of the model. We want to make sure that investors that are invested in these on your platform, we're trying to do it as tax efficient as possible. So that's a whole series of buy and sell decisions that try to maximize the long-term gain for investors that have taxable money on your platform. That's important, trying to maximize the long-term gains and or harvest losses in the portfolio.
Yeah.
That's something we kind of haven't talked about, but that's an important thing to mention here. So these are all the characteristics that go into the investment process and how basically the portfolio is constructed.
No, I love the strategy. It's something that we talk about here internally at Echo Trade that, I think we've built something that really is kind of, relatively revolutionary and kind of changing the way people can get access to portfolios. But at the end of the day, we don't have to recreate the wheel with everything that we do. And so one of my favorite quotes is, I think it's Picasso that said, good artists get inspiration and great artists steal. And so you guys are stealing, but it's readily, information available, from the best in history on the investment side. And it's 65 different strategies that you're using to kind of, steal all of those to figure out what's the best possible portfolios of trying to, saying I'm the smartest guy in the room and I'm smarter than Buffett and Dolly and the rest of these guys by creating your portfolio. So it's a fantastic kind of, method that you guys are looking at. I guess, how can you look at this in terms of time horizon? If I'm an investor, what am I looking at? What do you guys look at in terms of time horizon? Like you said, you have the different fundamental factors that you're looking at to put something in, but also take it out. Do you have a time horizon on any kind of individual company that you put into the portfolio that you're looking at? Hey, based off of these fundamental factors, we're thinking, it's going to reach a value in the next, 2 to 3 years, or 1 to 6 to 12 months, or 5 to 10 years.
We don't have intrinsic value valuations as part of our process. It's all about what stocks score highest according to the combined models or consensus system we're using, and then allocating to those. I think that what you probably find with this portfolio is these holdings will tend to be a little bit longer term in nature because, like we talked about before, there's hopefully less variability in their profits because they have such a dominant position. So I think these types of companies are likely to be held in the portfolio for a longer period of time versus our other strategies we run with you. But I would say that from an investor perspective, in terms of investors allocating money to this portfolio, what I like to say is, you should try to take the longest time horizon possible. And that's hopefully a multi-year time horizon on getting the most out of the portfolio. All the portfolios we run on EchoTrade, and any portfolio or strategy I think that you follow, you're going to have periods when, it may not work and they may struggle for one reason or another. Like, for example, this strategy, if it becomes like a risk-on environment and, all the low quality stocks are rallying, based on the names in this portfolio, I don't think that that's going to keep up with the broader market. If, the market changes and starts to really pay attention to profits and quality, and that could even be in an environment where maybe even like we're in a little bit now, where, you're sort of seeing some weakness in stocks here in August after, a strong June and July. These are the types of names that are going to hold up because there tends to be in periods where investors get nervous, there tends to be like a flight to quality to some extent. And so I think that that's where this portfolio, will shine. And hopefully over the very long term, the alpha is there and it generates alpha and it compounds wealth for clients in it. But these are the types of, I'm just trying to, explain the types of environments where this strategy may not work, or it may work better.
Yeah, exactly. But at the end of the day, the idea is, EchoTrade is not really a trading platform per se. This is for longer term investments for different types of goals. But this is a good portfolio to be able to withstand, the different types of markets. And again, as a wide moats and big brands, that should be able to withstand quite a bit. But anyways, Justin, I appreciate you being here. Investors can take a look and they can unlock the portfolio and see the positions and the commentary from the team at Validea by checking out Wide Moats and Big Brands on the EchoTrade platform. So thanks, Justin.
Thank you, Jeff.